Okay, so we're going to work on some closing entries and some issues surrounding the closing process using the Openstax exercises from openstax.org. And this is their chapter 5 from their end of chapter material. So we start with EA1. Identify whether each of the following is a nominal, which is the same as temporary, or a real, which is the same as permanent account. So if it's nominal or temporary, that means it's not going to carry over its balance into the new year, into the new period. If it's real or permanent, it will carry over its balance. So nominal and temporary are the type of accounts that will be closed out at the end of the period, and they would reset to track the next period's balances. So the ones that are temporary and nominal, let's mark those with a nominal, an N for nominal, and we'll mark the permanent ones as a R for real. Okay, so accounts receivable at the end of the year, the last of the year, there's a balance in accounts receivable. You don't reset to 0 on accounts receivable. You want to carry over your accounts receivable to this, at the same balance it was December 31st or whatever your year end is. So that would be a real or permanent account. Fees earned revenue, any revenue, expense, or dividends would be the ones that would be the temporary accounts because those are the ones that are closed out. So the nominal would fit there for the revenue account. Utility expense, likewise, is a temporary account, nominal. And then prepaid rent is a permanent account. It's an asset. So we'll call that a real rather than nominal account. Now the next one, we're going to still do nominal and real on this one, but we're also going to say what statement would it go on? Interest expense. If it's on the income statement, it's going to be nominal, right? So, or if it's dividends. So interest expense is nominal and it's on the income statement. Buildings are permanent or real, and they're on the balance sheet. Interest payable, also real or permanent and on the balance sheet. Unearned rent revenue, it says the word revenue, but it's not actually a revenue account, is it? It's a liability. So that's a real account that goes on the balance sheet. All right, EA4. The following accounts and normal balances existed at year end. Make the forward journal entries required to close the books. Now this assumes the 4-step methods, but the 2-step method is exactly the same thing. It just squishes together entry 1, 2, and 3. So we're going to look at these accounts to see which ones should be closed in the first entry. That would be only revenue accounts. And then which should be closed in the second entry. That would be only expense accounts. And then the dividends will be closed in the last entry or the 4th entry. So the revenue looks like this. 85,000 is the only revenue item we have. Service revenue. So service revenue is a credit balance account because it's revenue. But when you're closing, you do the opposite because what you're trying to do is bring the balance in that account to 0 by closing it out. So the only way to bring a credit balance account to 0 is to debit that account. So we are going to debit service revenue and credit this super temporary account called income summary. It's also called a closing account. We're going to credit it for 85,000. So if we had 4 revenue accounts, we'd list every one of them right here individually, and then the total would be posted as a credit to income summary. And when you're dealing with the expenses, these are all debit balance accounts in expense. But when we close them, we have to do the opposite in order to 0 them out. We're trying to bring their balance to 0. We're going to ultimately dump their balance in these temporary accounts over into retained earnings. So we're going to take each expense account one at a time, and we're going to close them as in posting the opposite of their normal balance. Whatever their ending balance is, we're going to credit it if it's an expense. And that way it's going to wipe it out to 0. And we're going to collect up the total of the expenses in this super temporary account again called income summary. And that is a total of 67.1 in this case. So then what we do is we look and see what's the total of income summary It's got a credit of 85,000 and a debit of 67,1. So we're going to close the income summary account as step 3. And that means income summary had a credit balance of 17,9. So we're trying to wipe it out and dump it into retained earnings. So we're debiting income summary and we're crediting retained earnings. You could have combined these by just deleting the entries to income summary and making it one entry. I'm going to show you by just blacking out income summary in every case. Income summary, if it disappeared in all 3 cases where we've got it, you'd have exactly the same results with just one entry. You'd have a debit to service revenue to clear out that account. Then you'd have credits to each of the expense accounts. And you'd have one more credit to make it balanced because you have to have the debit column has to equal the credit column on every entry. So if this was one entry instead of 3, this is what you would be looking at. A debit to service revenue of 85,000, credits to each of these expenses for the amount that was their balance in their accounts. And then the balancing entry would be the 17,009, and it would be a credit to retained earnings. So you do the clearing of the revenue and expense first, and then you decide which direction you need to post a balancing entry to retained earnings. Okay, so since we're using the 4-step here, I'm going to back those back up. But the 2-step is just exactly the same. It's just it combines entry 1, 2, and 3. Okay, and then the last thing we need to do for our closing is to close dividends. Dividends has a $4,000 balance and it's always a debit. Expenses, dividends, and assets all have a debit balance normally. So to close it, we're going to credit dividends and we're going to go straight to retained earnings with this. Oh, look at that. Let's go back and get the font changed instead of the background. Okay. Sorry. Okay, so that's good. That's all we have to do that one. Now this one is another closing entry. It says the following accounts and normal balances existed at year end. Make the 4 journal entries required. So 1, 2, and 3, we're going to do separately, and then I'm going to black out the income summary so you can see what it would be if you were doing the 2-step method. And then we're going to pick up closing the dividends last at $6,000. Now look at how they have an extra account. They have retained earnings. Should we close out retained earnings? No. Retained earnings is where we close to. We take all the revenue and expense and the dividends and we dump it into retained earnings. We're not actually closing retained earnings, even though we use the retained earnings count in the journal entries for closing. We are dumping things into it. We are not clearing it. Okay, so the first one is we're going to clear the revenue or close the revenue. In this case, it's fees earned revenue. Service business. Fees earned revenue is a credit balance account, so we debit it when we close, and we close it to the income summary account. Then we pick all the expense accounts. They are expenses, debits, so we're going to close them with a credit, and we're going to close them into income summary. 3 expense accounts, right? Yep. And then we look at it, we say, okay, well, now I have to close income summary. What is the balance of income summary? It has a credit of 90,000 and a debit of 63,300. So it's going to have a credit balance in income summary. So we will be debiting income summary for that difference. 26,700, which is just 90,000 minus 63,300. Okay, then we close the dividend account of 6,000. It's a debit balance account. So for closing, we credit it and we credit it directly to the retained earnings account. Now, if I wanted to do, instead of 4-step, if I wanted to do 2-step here, it would be the same exact entry, except for there would be no entries for income summary. So it would be this entry. It would be a debit to fees earned and 3 credits to the expense accounts, and then a credit to retained earnings. That's if we did the 2-step method, which means close all revenue expense in one entry and then close dividends in the second entry. Okay. Now, the next one says for each of the following accounts, identify whether it would be closed at year end with a yes or no, and which financial statements the account would be reported on, either the balance sheet income statement or retained earnings statement. Retained earnings, will it be closed? I'm just going to go ahead and highlight these and we'll talk through it then. All right, retained earnings is not closed. The only thing we close are the temporary accounts. So that's the income statement accounts and dividends. We're going to close all revenue, all expense, and dividends. So retained earnings does not close. Prepaid rent does not close. Rent expense does close. Rent revenue does close. Salaries expense does close. Salaries payable does not close because it's a liability. Supplies expense does close. Unearned rent revenue, which is a liability, does not close. So this retained earnings, where will it show up? Okay, it's going to show up on the balance sheet, and actually it's going to show up on the retained earnings sheet too, of course. Prepaid rent shows up on the balance sheet. What? Oh, it's a B missing. Come on. I was like, what's this S? Rent expense and rent revenue and salaries expense all show up on the income statement. Salaries payable on the balance sheet. Supplies expense on the income statement, and unearned rent on the balance sheet. So if it had dividends listed there, you would say it shows up only on the retained earnings statement. All right, identify which of the following accounts will be listed on the company's post-closing trial balance. So this is after the close, which ones would still survive. So when you think about which ones close, you know that all the balance sheet accounts are going to survive, and only the revenue, expense, and dividends are going to disappear. A through H. So yes, accounts receivable will still be on the post-closing trial balance. So will accumulated depreciation. Cash will still be there. Office expense will not be there. So this one will not be on the post-closing trial balance. And then E, note payable, yes, that'll be there. Rent revenue will not be on the post-closing trial balance. And then retained earnings, yes, of course, that'll still be there, the post-closing trial balance. And unearned rent revenue, since it's a liability, yes, that will be there. Only two that will go away of this group are the office expense and the rent revenue. That's because the only thing that disappears in a post-closing trial balance are the temporary accounts. That's revenue, expense, and dividends. Okay, this is the last one. EB4, following accounts and normal balances existed at year end, make the 4 journal entries required to close. So we see that we have dividends, we have 1 revenue, and we have 4 expense accounts. So we start, the first entry is to close revenue to the temporary account income summary. So it's a 120 credit balance. So in order to close it, we debit 120 to sales revenue. Then the expense accounts, there's 4 of them. They're all debit balances, so we close them with a credit, and then we total it up and debit that amount to income summary. Then we look at the income summary and say, all right, I need to close income summary now. 120 credit and a 90,500 debit. That means it's going to have a credit balance in income summary. So I'm going to close it with a debit. And it's the difference between 120,000 and 90,500, which is 29,500. So we debited income summary to wipe out the balance in it too. So now that super temporary account is gone. So once you close it to retained earnings, it's no longer got a balance in it. It doesn't show up on any balance sheet or income statement, not even retained earnings. It doesn't go anywhere. Income summary is just a closing account. So if you wanted to do it in the 2-step method instead, you could just ignore income summary. It just doesn't always want to do what I say if you didn't notice. I'll go up here and try it. And then we would ignore this income summary also. And that would put us with just a debit to sales revenue, a credit to all the expense account balances, and a credit to retained earnings for the difference. So when you took the debit of 120 and compared that to your credits you had right here, you would be off. It wouldn't balance unless you added another credit for 29.5. That's how you know how much to put to retained earnings. All right, and then the last one is the dividends. And again, it's showing up as a $6,000 dividend. We'll put these all back to right. And that is all. This is coming from the Openstax chapter 5 into chapter material. This one is EB4. Let's see what the other one was. EA5. Okay. They had the same amount of dividend. I just had to check and make sure they weren't the same. Okay, so that's got it. And we will come back with another chapter later.